Hey, soldiers, by now, I'm sure you've heard Fitch, the credit rating agency, has downgraded the United States of America. I wonder why. Why, oh, why would America be at risk with regard to its credit rating? All right, listen, this is a very serious story. It has ramifications and an impact on you if you are an American or you live in the West or really anywhere in the world, considering the fact that the United States right now has the dominant currency out there, the world's reserve currency. So let me tell you how we're going to cover this. First, we're going to look at why Fitch downgraded the U.S. It's not the first time a credit rating agency has done that. We'll cover that briefly. Then we're going to look at the alternatives to U.S. debt that other countries have, and the fact that they are availing themselves of those alternatives at historic rates indicates that they're falling out of love with the dollar. Finally, we're going to explain to you what it means to you and how you can mitigate your exposure to this. So listen, what has happened, basically, you can think of it as the equivalent of, if you ever gone out there, I know I did when I was a college student and I overextended myself and it affected my credit rating. My credit rating dropped, all right? And it became more expensive for me to get a car loan when I went to do that because they were like, hey, you're a greater risk, okay? So that pretty much encapsulates kind of what happens. Now, will this have a tremendous effect on the United States of America from the standpoint of debt purchases? We'll get into that. Fitch, the rating agency, downgraded the U.S. government's credit rating weeks after President Biden and congressional Republicans came to the brink of a historic default, warning about the growing debt burden and political dysfunction in Washington. The downgrade, the first by a major rating firm in more than a decade, I told you this has happened before, is evidence that increasingly frequent political skirmishes over the U.S. government's finances are clouding the outlook for the $25 trillion global market for treasuries. Fitch's rating on the U.S. now stands at AA+, or one notch below the top AAA. All right, so their FICO score has ticked down a few points. And this is a country, this is supposed to be one of the largest economies in the world. America's reputation for reliability and making good on its IOUs has cast Treasury bonds in an indispensable role in global markets, a safe haven security offering nearly risk-free returns. Treasuries serve as a critical benchmark for returns on stocks and other bonds because investors generally demand greater yields on any other securities that they buy. And when you see a credit rating downgrade, if you're buying a corporate bond, if you are lending money to Cousin Larry, and Cousin Larry, you know that he cannot go to a bank and get a loan, then you might be asking Cousin Larry for some collateral, or you might say, hey, I ain't got it, okay, in order to just not lend to a great credit risk. Now, of course, we're not there yet. U.S. Treasury bonds, in terms of the debt of any other country, are still considered stellar. Okay, it's the United States of America. Even though the country is on the downswing, unfortunately, it's end of empire days, we are still the most powerful country in the world militarily for now. And again, our economy is still booming for now. We are the prettiest of the ugly girls at the dance. Few investors believe that Fitch's downgrade will immediately challenge our dominance. Still, it isn't the first time a ratings firm lowered its headline assessment of the U.S. government's propensity to pay its bills on time, since Standard & Poor's in 2011 lowered its rating one notch below their top grade, and they still have us lowered. Okay, so two of the three have us just below their top rating. Moody's is the third. and they continue to rate the United States as the strongest in terms of credit risk. So we're 2 out of 3, 66.6% of them say you're not the absolute best gold-plated anymore, United States of America. And this is one of those things that we see happen. Again, end of empire. We have totally and just abhorrently mismanaged this economy. And when you see things like the sanctions and the weaponization of the US dollar, when you see things like the fact that we really don't have a debt ceiling right now, and you're a credit rating agency, so you got Janet Yellen out there and the former Treasury Secretary Larry Summers, they're crying like stuck pigs because of this downgrade. And it's like, where have you been? All right. How do you really believe we're going to pay back $32 trillion? Mind you, that is your obligation by and large as a taxpayer. Now let's talk about some of the alternatives to U.S. debt that other countries are taking a look at, some of which you can do yourself as just a private citizen. Did you know that about 18% of the total debt is held by other sovereign nations? That's right. And let's see, we've got some data for May. The sum total in May of 2023 of all net foreign acquisitions of long-term securities, short-term U.S. securities, and banking flows was, $167.6 billion. But what are countries taking a look at in terms of buying other things to put, other assets to put inside their holdings? Gold. Okay. Now we have had a lot of gold purchased in the first half of 2023. Despite significant selling by Turkey that slowed net central bank gold buying in the second quarter, central banks added a record amount of gold to their reserves through the first half of 2023. Net central bank gold purchases totaled 387 tons through the first half of the year, according to data compiled by the World Gold Council. That was the highest first half total since the organization started compiling quarterly data in 2000. Now, okay, they're talking about 387 tons of gold at the current price of gold hovering around $2,000. We're looking at of gold purchased by central banks in the first half of 2023. Now, mind you, that does pale in comparison to the $168 billion of treasuries that were sold in May in 1 month. It's about, 17% or so, maybe about 15%. My math is not that quick. But we do have these countries accelerating the purchase of assets other than U.S. debt. And again, a large part of that is because of the weaponization of the U.S. dollar. And we've got other alternatives coming online soon. Possibly this month, August, the BRICS nations will meet in South Africa and they will announce their intentions with regard to a BRICS commodities-backed currency. So we'll have to see what develops with regard to that, okay, and whether or not that will catch on. It's not going to be an instantaneous process. Whatever they decide to do, it will take decades to become a force to be reckoned with. But look, I've been married for 2 decades, and it went by like that. So, and never think that you're too old. I talked to someone the other day, and they said, "Oh, well, I'm too old to get started investing." And this person's 70, okay, and the family has a lifespan of the late 90s. So I told them, it's never too late. Never too late. All right, so let's take a look at what this means for you and how you can mitigate some of these outcomes that are going to flow from this downgrade. And again, Moody's is the last credit rating agency standing before the United States of America has the trifecta of second tier credit ratings. Okay. All right. So the amount of federal debt, which is projected to be $50 trillion by 2032. Remember, we as American citizens hold about 80% of that debt. And we're responsible for it at the end of the day. As you can see here, it's over $250,000, over $250,000. Every single taxpayer has that obligation. But because our senators and congresspeople and presidents like to build in laws that insulate them from the brunt of this type of taxation. All right, so what does all this debt and what do these downgrades and credit ratings mean for the economy and specifically for us, right? We are the economy. When you talk about this debt, 80% of which is held by the U.S. citizen, the taxpayer, okay, when you talk about the debt, think about it in terms of taxes coming out of your wallet, taxes that if you can legally mitigate them, you can retain some money to purchase assets that will offset inflation and keep your head above water. Well, these are the risks that we're running with these debts. And again, the debt has been the biggest factor in this downgrade. That debt reduces private investment and slows the growth of the economy, increases the interest payments to foreign holders, thereby potentially reducing national income, elevates the risk of a fiscal crisis, leads to higher interest rates. Money becomes more expensive. A lot of people out there complaining right now that they can't afford a home because the prices are high and the interest rates are high. Constrains lawmakers from implementing policies to respond to crises or invest in the future. Responding to crises like saying, look, we're spending too much damn money, all right? We spend, more than the next 8 countries combined on our military. Can't we? I think we may be able to. Can we make it the top 7 combined? Are we still going to be safe doing that? It impedes intergenerational equity, preventing future generations from accessing public goods and services. What do they mean by that? Well, that's quite simple. Social Security, Medicare, Medicaid, of course, those programs may very well have to be cut in the event that the U.S. debt continues to skyrocket. Or you could have to say to people in their 20s right now, you're not going to get these benefits at, say, Medicare at 65. You got to wait until 70, all right? So those are some of the things that can happen. Now, again, just revisiting point number 2, one of the things that you can do to preserve some of your wealth and buying power is what these central banks have been doing, which is think about, see if it matches and fits with your objectives, adding some gold, silver, or some other type of investment in a commodity that tends to hold on to its value over time. Now, I think that's something you should think about. Again, this is not advice. This is insight. Soldiers, there is the potential for another economic crisis right around the corner. It's a recession. This isn't doom and gloom. This is forecasting. Take a look at this video where we look at 3 metrics and say, hey, the government is not telling the whole truth here. They're saying everything's rosy, but when we look at these 3 metrics, it could indicate that Jerome Powell's interest rate hikes are working to slow down the economy. And we showed you before how when Paul Volcker raised those rates, it kicked us into a recession back in the 80s. It's the same thing happening now. Listen, you can't trust the government, but you can trust the data if you look into it deeply enough. Watch the video, guys. I'll talk to you soon.